Can artificial intelligence or AI create a good cash forecast if a company's data is spread across bank websites, spreadsheets, accounting systems, and even paper records? The answer is yes, but the data must be organized first. Welcome to Star Treasury Insights, snack-sized the industry perspective. I am Sudeep Sharma, a certified treasury professional or a CTP and founder of Kuber Treasury Solutions LLC. Today we are answering this question. What does AI need to forecast treasury positions accurately? Let's break it down using the STAR method: situation, task, action, and result. First, the situation. Imagine a technology company that wants to use AI to improve its cash forecasting. The problem is that its financial information is scattered. Bank balances are stored on several banking portals. Customer invoices are kept in accounting software. Supplier payments are tracked in spreadsheets. Some older information may even exist only in paper files. The chief financial officer or CFO wonders whether the company has enough good data for AI to work. That is a fair concern. AI can find patterns, but it cannot create reliable forecasts from information that is missing, confusing, or badly organized. Next comes the task. Now, before buying a new forecasting tool, the company needs to understand what information is most important to them. The goal is not to collect every piece of financial data in the company. The goal is to start with the information that directly affects cash coming in and cash going out. Now, the action. The company works with a consultant and identifies four main types of data. First, it needs bank balances and transaction history. This shows how much cash the company has and how money has moved in the past. Second, it needs accounts receivable, often called AR. AR is money customers owe the company. Useful information includes invoice amounts, due dates, and how long customers usually take to pay. Third, it needs accounts payable or AP. AP is money the company owes suppliers and other parties. This helps the forecast estimate when cash will leave the business. Fourth, it needs historical cash flow information. This includes past inflows and outflows, such as payroll, rent, taxes, customer payments, loan payments, and major purchases. The company then spends several weeks bringing the information together, correcting obvious errors, removing duplicates, and placing transactions into clear categories. Finally, the result. Once the data is organized, the AI system begins producing useful forecasts. The first forecast may not be perfect, right? But as more information is added and the transaction categories improve, the forecast can become more stable and reliable. Now, this project also reveals larger problems such as missing records, unclear ownership, and inconsistent transaction descriptions. That helps the company improve its overall data management. Here is the industry perspective. You don't need perfect data to begin. You need data that is consistent, organized, and reasonably accurate. For many companies, bank records, accounting systems, enterprise resource planning systems, and payment schedules provide a good starting point. And the main lesson is simple. Better AI forecasting begins with better financial data. So start with bank balances, accounts receivable, accounts payable, and historical cash flow. Clean what you have, improve it over time, and let the forecast grow stronger as the data improves. This is Sudeep Sharma with Star Treasury Insights, snack-sized the industry perspective. One treasury topic explained in plain English under 10 minutes. Don't just improve, evolve. See you in the next one.